Every instrument has an algorithm price engine that literally drives the market up and down, and it attacks resting orders. It entices buying and selling. There's no buying and selling pressure driving it up. No more than the 3 or 4 ticks above the high that has a standing base of orders, maybe in tune of 250 contracts. But 2 ticks above that, there's another 300 handles, 500 handles, 10 handles above that, but it stops just above to bump those, leaving all that real juicy liquidity. You mean tell me that nobody's interested in being a buyer? That they can't just rebook and send that price higher to higher to higher just to absorb that liquidity up there? They don't want it there. That's why it never goes there. It's controlled. They leave that up there because when they start sinking the market, more shorts are going to enter the market and that liquidity increases. Because what you're watching is the net longs that the smart money's holding, they need to exit, the liquidity to exit out of that. So they want to build these big pools of liquidity above old highs. That's why turtle soups work. That's why they work. Linda Rash's book never covers that. And you can go and look at her book. Look and see if Larry Connors and Linda Rash mentioned that's the reason why the turtle soup forms. They just say they're capitalizing on a pattern that historically has been proven 70% effective by being contrarian to what the turtles traders methodology was, which was buying a breakout of 20-day highs and lows. You ever seen me using a 20-day high and low? Fuck no. But the concept of a false breakout, which I didn't invent that, they didn't even invent that. They just gave you a specialized system of entering around that idea or premise, which is why I think the book was great when I first got a hold of it. I paid $175 for that book. I don't know what it goes for now, but I don't regret paying that much for it because it gave me an insight about stop hunts that it solidified a concern I had that validated it for me. Because if these people are writing a book about it, then they saw it too. So if they saw it too, then hey man, to me that validates it. It wasn't something that I'm just feeling like it's it's limited just to me, which in trading can trick you. But if it's a large sample set of data suggesting something that's there, then the premise is probably having weight to it. Knowing how a turtle soup will form before it forms, same premise. A turtle soup can form right before a macro or just after a macro begins. But knowing the narrative of how that daily candlestick is going to form a down close day or an up close day is going to be understood based on where the liquidity is and how we start the day. Is it going to rally first and create the high of the day, or is it going to sell off initially, trick people short, leaving relative equal highs that they run for later in the day? That creates the high of the day, and the only thing they're really running out is the engineered buy side liquidity. Then send it lower for the close, and that's your narrative. That's the bias is short, but it isn't always open go straight down close. How we trade initially after the opening, because in a perfect world, what we want to see is when we're bearish, it opens, rallies up, and takes out the liquidity above 7 to 9 o'clock in the morning, or London high, or Asia's high. And we use the economic calendar to bridge that, which one do I really want to focus on? But we always, every single day, use the liquidity that's formed just after 7 o'clock Eastern time, prior to the 9:30 opening bell. Those pools of liquidity cannot be hidden from you. And when it's a clear, obvious relative equal high or relative equal low, and it would match how the daily candlestick should form for the purposes of Power 3. In other words, you're bullish, your bias is bullish. You think the weekly chart's going to keep working towards a level higher. Okay, wonderful. That means you're going to be looking for easy bread and butter idea is at 7 o'clock in the morning, go to 9:30. At 9:30, in that last 90 minutes, where is the relative equal lows? If there is no relative equal lows, just find the lowest low, if it's a singular low. That's where you're going to expect the price to drop down in a perfect world. But because we have to watch and see what the opening range can do for the first 30 minutes, unless it just does exactly what we're expecting right out the gate, which is a Judas swing, and when we're bullish, it drops down and goes for the liquidity. Then you know what you're waiting for. Go down there and get it, soup it, use the first resistance fair value gap that you come to after it runs the liquidity. Okay, it's a little variant on the gauntlet. It doesn't have to have a breaker there. Okay, So running it, I just slip that in there, and people that didn't stay on, they didn't hear that. But the raid after going down to hit that sell side, even if it's going to go lower, the chances of you getting 50% of that drop down, that many times can be a trade. It can yield you 20 handles. It could yield you, and in today's volatility, it could be as much as 50 to 100 fucking handles. It's relative to what you're seeing in terms of volatility at the time when you're looking at the market versus, well, guessing what it's going to do. Yeah, there's a process of you determining what liquidity it should reach for. Perfect world, it drops down for liquidity, makes the low of the day, and then all day long, the rest of the day, it just keeps going higher. That's a perfect classic buy day. They happen about 4 to 6 times a year. A month. Every other day might get like you're bullish. Your bias is bullish. The weekly chart, you're calling for a specific premium PD array. And then the market rallies first. Well, that don't make any fucking sense. You want to see it drop down. What do? You wait. And then if it's left relative equal lows during the opening range, it's going to come back down for the silver bullet to get that. And then run higher going into the lunch. And then whatever short-term high that's in the middle of that run, it'll bump down into that during the 2-hour lunch period, hit that liquidity, and then expand for the rest of the day, give you the classic up close when you're bullish. Now, a apt pupil, someone that's really interested in wanting to learn, they'll go down into the 15-second chart and look for every relative equal low when it formed and when they ran through that and then sent price higher. And that is your everyday model. That's your everyday deliver. Every time you get in front of the charts, you're looking for that. And that forms every 60 minutes. You got to know what it's reaching for, though. You derive that from a weekly and a daily chart minimum. Nothing less than a daily chart. But primarily, you want to use a weekly chart. What is it reaching for? And every relative equal low on a 15-second chart, once it's rated, if you take the first present to fair value gap, after that, you have a high frequency trading algorithm right there. First short-term high or relative equal high or any inefficiency above it, that's your first partial. And then you hold it and see if it can start delivering to that higher time frame target. And then if it does, once you get up to 11 o'clock, if you can afford to take a partial, do so. Because you might have the lunch hour, which is really 2 hours long. It could retrace and go even beyond where you got in at and shoot for a London low, upset the people that are in there long. That's more likely to occur if you're in the discount area of that primary range that you're expecting to see delivered on a daily or weekly basis. In other words, that draw liquidity that you're aiming for bias purposes. When you're in the first half of that price run that would materialize, there's going to be stop hunts like that will occur. So you have to trade differently a little bit there. But when we get to a premium side of that price run, you won't see these big drop down. They won't need to come down there because they want to get closer to that exit strategy of getting out at that pool of liquidity or that inefficiency that's a premium